Good afternoon, everyone, and welcome to the Loggers Payment Options and Retirement Process webinar. Today we'll go through and discuss all of the payment options available under Loggers and the process to actually apply for retirement with Loggers. A couple of housekeeping items before we get started. This webinar will be available as far as recorded on our website. And also a PDF of the slideshow presentation will also be available on our website on the webinars page. Also, throughout the webinar, if you have questions, there is a question feature on the right-hand side with the menu bar that popped up whenever you logged into the webinar that allows you to send messages to me and ask me questions. Throughout the webinar, I will do my best to answer them as we go through. If they're too specific or if I don't quite get to them, I will do my best to answer them after the webinar via email because I do have a record of who sends what messages. So we'll go ahead and get started. As a Loggers member, you have several options from which to choose from that will allow you to receive a benefit, and there's several different ways that the benefit can be payable. There's the non-joint survivor option, also known as the life allowance. The 10-year payment certain, also known as option C. The joint survivor options, also known as options A and B, and the partial lump sum feature that can be applied to all of the payment options. Each of these will be discussed throughout this webinar, and again, if you have questions, please just use the question feature on your menu. First and foremost, once a Loggers member begins receiving their benefit from Loggers and they've elected a payment option, that payment option is irrevocable. So when they make the decision of how they want to receive it, they can't change it once they've begun their retirement benefit. So that's why it's important to understand these payment options, because if you get 2 years into retirement and decide, oops, I made the wrong decision, unfortunately you can't change it. So first, let's go through the life allowance. The life allowance is the highest amount that a member can receive from Loggers. However, when the member passes away under the life allowance, nothing is payable to a beneficiary. It's calculated by taking our benefit formula entirely unreduced. So you would take a benefit factor times the final average salary times years of service credit, and that would give you the life allowance amount. For example, assuming that the member has a 1.5% multiplier, or the L7, a $3,000 final average salary, and 25 years of service credit, this is how we would calculate a life allowance. We would take the 1.5% times the $3,000 final average salary times the 25 years of service credit. Multiply the three of those together, and that will give you $1,125 per month that's payable for the member's lifetime. When the member passes away, there is no monthly benefit payable. However, if the employee does have contributions in the system, those employee contributions are guaranteed. So if you work for an employer that requires you to contribute 4% of your gross pay, and you pass away after you have elected the life allowance, and you still have employee contributions left in the system, those contributions would be refunded to your beneficiary of record at Loggers, which is another reason why it's important to keep your beneficiaries up to date. There isn't a scenario under Loggers that allows for a member to not at least receive their contributions. So the member or their beneficiary to receive the employee contributions. Option C. Option C pays 95% of the life allowance to the member with the added provision that if the member were to pass away before a total of 120 payments or 10 years worth of payments are paid. So let's go through some examples of how the option C actually works. I had a question about employee contributions, so we'll take a step back before I move forward. And it says, can my son be my beneficiary since I'm single and have member contributions? The answer to that is yes. Now, your son can be your beneficiary for your member contributions. Now, which we'll get to a little later, under option A and option B, your beneficiary can only be a spouse, but we'll talk about that. So back to the example under option C. In this example, a member lives 84 months or 7 years after retirement, and they elected option C when they retired. So we do the calculation for the reduction of the benefit. We take that 5% off of the benefit, which gives us $1,068.75. So that is the benefit that the member receives for the remainder of his or her lifetime. So in this example, the member retires on January 1 of 2010. And then the member passes away on January 1, 2017. So during that time, the member was receiving their benefit. In fact, they received 84 payments of $1,068.75. And they received that for their lifetime. Okay? But they passed away under option C before a total of 120 payments are paid. So what happens is the beneficiary begins receiving a benefit. The beneficiary would then receive, in this case, 36 months or 3 years worth of payments of $1,068.75. Okay? In that case, after the total of 120 payments are paid, the benefit ceases. It stops. So on January 1, 2020, the benefit to the beneficiary stops because a total of 120 payments have been paid. So what happens when a member outlives the 10-year period under option C? Well, we still do the same reduction of 1,125 times 95%, which gives us $1,068.75. In this example, again, the member retires on January 1, 2010, and then the member passes away on January 1, 2022. So the member received 144 or 12 years worth of payments of $1,068.75. But in this case, because the member outlived 120 months, there are no benefits payable to a beneficiary under option C. The only thing that could potentially be payable would be employee contributions. However, the way LAGERS views your employee contributions is if you have $10,000 in employee contributions, the first $10,000 you receive from LAGERS in your monthly benefit is considered your contributions. So the likelihood of you actually still having contributions left under this scenario is very unlikely. A few things to remember about option C. First of all, your beneficiaries, they do not have to be a spouse. It can be anybody you want under option C. You can have more than one. You can have more than one primary or contingent. So you can have more than one primary, you can have more than one contingent. If you have a very complex set of beneficiaries that you like option C to work with, contact our office and we will do our best to accommodate those with you and make sure that we get it the way that you want it. But if it's extremely complex, you may want to potentially set up a trust because the payments can be a trust or a charity. Also, your beneficiary can be changed throughout retirement under option C. So this means that if your beneficiary were to predecease you under option C, what you would have to do is name a new beneficiary. Okay, real quick pop quiz. I know that you're probably thinking I didn't come into this for a pop quiz, but I'm gonna propose this to you, and hopefully you can answer it. If a member who has elected option C lives for 9 years and 11 months into retirement and passes away, how many monthly benefits are payable to the beneficiary? Is it 1 payment, 5 payments, or 3 payments? Now I'm going to go ahead and launch what's called a poll, and that way you guys can give me an answer, and I'll leave it open for about 20 seconds. So give me just a second, and I'll get this launched. All right, you'll have 20 seconds to answer the question of if a member who elected option C lives for 9 years and 11 months into retirement and passes away, how many monthly benefits are payable? All right, so 95% of you said 1 payment. That is the correct answer. The reason that is because option C guarantees 10 years worth of payments. Someone lives 9 years and 11 months, there's only 1 more payment remaining. Okay, LAGERS joint survivor payment options. What these do is they pay for what is called 2 lifetimes. So they're going to pay a monthly benefit to the member, and when the member passes away, a benefit could potentially be paid for the spouse's lifetime as well. So here's the first one, option A. So option A pays 85% of the life allowance to the member for their lifetime, with the added provision that if the member passes away before the spouse, that something could be payable for the spouse. So here's how it's calculated. We take the member's benefit, which is the life allowance, times 85%. And that would be what the member would receive for their lifetime. The spouse's benefit is equal to what the member was receiving times 75%. When both the spouse and the member have passed away, there's nothing else payable unless employee contributions remain in the system. Like I said earlier, if there are employee contributions remaining, the beneficiary of record that we have with LAGERS will receive the refund of those contributions. So here's what it looks like mathematically. Assuming that life allowance of $1,125 again, what we would do is we'd take that times 85%, and that gives us $956.25 per month for the member's lifetime. when the member passes away, the spouse would receive 75% of the $956.25, which would give, in this case, the spouse a benefit of $717.19 per month for his or her lifetime. When both the member and the spouse have passed away, again, there is nothing payable unless employee contributions remain. Now, you may have seen it on the previous slide. It said adjusted for age, and it was in smaller print. I wouldn't call it fine print, but smaller print. So the amount received under option A may vary depending on the age difference between the member and his spouse. For each year the member's spouse is younger than the member's benefit will be reduced by an additional 0.75%. And the inverse is true for the member's spouse who is older. So for each year the member's spouse is older than the member's benefit will be increased by an additional 0.75%. So here's what that looks like mathematically. So in this example, the spouse is 5 years younger than the member. We take the 0.75% times the 5 years, which gives us 3.75%. So that's going to be the additional reduction that the member would be assessed on their monthly benefit. So what it would look like is the member's benefit would be taking the life allowance times 81.25% instead of 85%. And the spouse's benefit would again be 75% of what the member was receiving. So if we want to use this as an example, again, using the life allowance of $1,125, in this example, we would take that times 81.25%, and that gives us $914.07, and that's payable per month for the member's lifetime. And then when the member passes away, the spouse is eligible for $914.07 times 75%, or $685.56 per month. Okay, again, just like the previous ones, this is payable, and when both the member and the spouse have passed away, there's nothing else payable unless employee contributions remain in the system. Option A and Option B are extremely similar. The difference is the amounts the member and the spouse receive. So they operate very similarly, but under Option A, the spouse receives more. Under Option B, the member receives more and the spouse receives less. So Option B pays the member 90% of his or her life allowance for their lifetime, and the spouse is then eligible for 50% of the member's benefit. So here's what it looks like. We take that life allowance again times 90%, and that would be what the member would receive for the remainder of his or her lifetime. When the member passes away, the spouse would be eligible to receive 50% of what the member was receiving. Okay? Mathematically, it looks something like this. We take $1,125, that's that same life allowance, times 90%. That gives us $1,012.50 per month for the lifetime of the member. When the member passes away, the spouse is then eligible for 50% of the $1,012.50, or $506.25, payable for the remainder of the spouse's lifetime. When both the member and the spouse have passed away, again, nothing is payable unless employee contributions remain in the system. Just like option A, the amounts may vary depending on the age difference between the spouse and the member. The difference is under option B is that the additional rate of reduction is different. Okay, so for each year the member's spouse is younger than the member's benefit will be reduced by an additional 0.5%, instead of 0.75%, just like option A. Okay, the inverse again is true for option B. For each year that the member's spouse is older than the member's benefit would be increased by an additional 0.5%. Okay, so again, just like option A, let's look at what it would look like if the member's spouse is 5 years younger. Okay, what we would do is we would take the 0.5% times the 5 years, which gives us 2.5% additional reduction. So instead of taking the member's benefit, or instead of using the life allowance times 90%, we instead, on this case, take the life allowance times 87.5%. And then the spouse is still eligible for 50% of the benefit that the member was receiving. So mathematically, it looks like this. We take $1,125 times 87.5%, and that gives us $984.38. That is payable for the lifetime of the member. When the member passes away, the spouse is then eligible for half of the member's amount, or $492.19. Again, when both the spouse and the member have passed away, there is nothing payable unless employee contributions remain. A few things to remember about option A and option B. One is the pop-up provision. I had a question come in about this. I wasn't ignoring it. I just knew I'd get to it a little bit later. If the member's spouse predeceases the member, so if your spouse predeceases you, what happens? The reduction for the payment option is removed. So what happens is you get what we call popped up to the full life allowance amount. Okay, this does not apply to divorce. This is only if your spouse predeceases you. If you divorce, what happens is the spouse that you have elected under option A and option B is always the spouse you will have as far as for payment options. So if you elect option A and then you get divorced, your ex-spouse will still receive a monthly benefit from LAGERS because they're the spouse that you elected under option A or option B. And that's because that benefit election is irrevocable, along with the beneficiary that you elect under option A and B is still irrevocable as well. The other part is, how do we define a spouse? We define a spouse for the payment options as someone married to the member 2 years prior to retirement, or someone who is aged 40 or older, is more than half supported by the member for 2 or more years, and there is a legal affidavit proving that that person has been supported by you for 2 or more years. If that's the case, then that person can also be listed under options A and option B. I believe the intent of that is so that if you have an adult child who is unable to take care of themselves, that maybe they could potentially be a beneficiary for you on your LAGERS retirement benefit. The partial lump sum. We call this a feature, and the reason we call it a feature is because this particular feature can be applied to any of the payment options that we've previously discussed. So you could have a life plus, an A plus, a B plus, or a C plus. Anytime you hear that, that means that there's a partial lump sum provision added to that payment option. Okay? So let's talk about what the partial lump sum actually is. It's equal to 24 payments or 2 years worth of the life allowance. So whatever your life allowance amount is going to be, take it times 24, and that would be your partial lump sum. Now this does not include the temporary benefit that's payable under life and temporary programs. So if you work for an employer that has a life and temporary program, there is, if you look at your benefit estimate, it says something along the lines of $265 at 65. Well, that additional that you would have $265 does not apply to the partial lump sum. Only the at 65 amount does. Okay? It's payable 90 to 150 days after your retirement. There's a couple things you need to know about this. We're going to pay it on 90 days unless you instruct us to do otherwise. If the reasons you would want to instruct to do this otherwise would be for tax purposes. So if you decide to retire in November, well, it's in October or something along those lines, but earlier in the year, and you want to delay it so that it falls on a later tax year, you can. You can delay it up to 150 days. That's as far as we'll delay it. We'll pay it on 90, but we will delay it up to 150 days if you'd like to place it on a different tax year. The other thing is the reason we pay it on 90 days is we want to make sure that the amount that we pay you is the correct amount. And sometimes it takes us a little while just to make sure that everything is correct, and we do that so that we get you the correct amount the first time, versus having to send you money later, or versus having to ask for money back, which that would be rather difficult if we had to ask for money back. This partial lump sum is not what you would call a full lump sum. As you can see in the title, it's partial. So you still receive a monthly benefit with the partial lump sum. You get a chunk of money up front, and then you still receive a monthly benefit for your lifetime. It reduces your monthly benefit by approximately 16%, adjusted for your age. And we'll talk about how that works here in a couple seconds. So if a member retired at age 60 and elected the life allowance with the partial lump sum, the calculation would look something like this. We would take the life allowance times 84%. That's reducing by that 16% for the partial lump sum. So we would take $1,125, and we would multiply that times 84%, and that would give us $945 per month for your lifetime. Plus, we would calculate the partial lump sum by taking the life allowance times 24 months, or $1,125 times 24, which equals $27,000. So you would, in this case, you would receive $945 per month for your life and a $27,000 partial lump sum paid to you 90 to 150 days after retirement. So the amount of reduction with the partial lump sum may vary depending on the age of the member. Our break-even age is age 60. That's when the number is 16%. That's when it's exactly 16%. If you're younger or older, it could be something a little bit different. If you're younger, you're actually going to receive less of a reduction. So what we do is for every year that you are younger than age 60, we subtract 0.4% from the 16% reduction. So for example, if you are 59 when you retire and you receive a partial lump sum, instead of getting a 16% reduction on your monthly benefit, you would get a 15.6% reduction on your monthly benefit. What if you're older? If you're older, it's inverse. Instead of your benefit being reduced by 16% for every year that you are older than age 60, your benefit will be reduced by 0.4% more. Okay? Now that may not make sense to you, so let's explain why we do that. the reason we do that is the partial lump sum is, in functionality, when we talk about this in general, it operates very much like a loan. So what we're doing is we're loaning you this money 90 days after retirement that you would have received in a monthly benefit, for your lifetime. Okay? So here's why it's a little bit more, because you have to think about it like a loan. If you think about it like a car loan, for example, if you have a car loan that has a term of 60 months for the same amount, or a car loan that has a term of 36 months for the same amount, the payment for the 36-month loan is going to be higher than the payment on the 60-month loan. Well, this works very similarly. If you have someone who retires at 60, we expect them to live 20 years. So they have 20 years to pay it back. And if you have someone who retires at age 65, then instead of having the 20 years, because we expect them to live to age 80, instead of having 20 years, they have 15 years to pay it back. So it's actually more of a reduction because they have less amount of time to pay off the loan. That's essentially how it works. So for example, a retiree who is 5 years younger than age 60, what we would do is we would take the 5 years times 0.4%, which gives you 2% less of a reduction to your monthly benefit. So we take the life allowance amount times $1,125. Oh, I'm sorry. We take $1,125 times 86%. Okay, normally we would take it times 84%. So we're only doing a 14% reduction here. And the monthly benefit would be $967.50 per month for the lifetime of the member, plus a $27,000 partial lump sum. Here's an example of the retiree being 5 years older than age 60. So they retired at 65. We take the 5 years times 0.4%, which gives you 2% additional reduction. So instead of the benefit being reduced by 16%, we reduce it by 18%. So the member receives 82% of their benefit instead of 84%. Take that 1,125 times 82%, and that gives you the $922.55 per month for the lifetime of the member, plus a $27,000 partial lump sum. Again, if you have questions, you can use your question box that's on the right-hand side of the user interface that was uploaded with the webinar software. Partial lump sums are subject to applicable taxes. You may delay these taxes by rolling it over into an eligible retirement account. I'll talk about that in a little bit more detail, but first let's talk about what happens if you don't roll it over. If the retiree receives the lump sum, that means they just take it and put it in their checking account. Loggers must withhold 20% and forward it to the IRS. Okay, this is what the IRS code has instructed us to do. The IRS has instructed us to withhold 20% and forward that. It does not include state taxes. The state may want a piece as well. So what we're going to withhold for is just the 20% for the IRS. If you're a general employee younger than age 55 or a public safety employee younger than age 50, and you take a partial lump sum and put it into your checking account, you'll also be subject to a 10% early distribution penalty. This early distribution penalty will not be assessed and not be withheld by us. What will happen is on April 15th, when you're doing your taxes, is when that 10% would be assessed. Okay? All of these withholding of 20%, the 10% early distribution penalty would be avoided if you roll the partial lump sum amount into an eligible retirement account. When I say eligible retirement account, I'm talking about a 401k type of account, a 457, an IRA. Something along those lines where the contributions you're putting into it right now are what are called pre-tax. So you're not being taxed on it right now, but when you begin withdrawing from that account, you will be taxed. Had a very good question that says, wouldn't that lump sum have been the employee's portion paid to loggers and already taxed? That's true. Your employee contributions are after tax, but it's not quite like that. Here's how it's interpreted. When it comes to employee contributions, the IRS uses what's called the special rule method. And they say, we expect this person to live X amount of months until from retirement until they pass away. And then they take your contribution balance and they divide it by that number of months, and whatever the smaller dollar figure that comes about is what's non-taxable. So that smaller amount times 24 would be what would be non-taxable on the partial lump sum. The rest would be. However, again, if you decide to roll it over, you would avoid the 20%. You wouldn't avoid it. It would just be delayed. But by the time you are maybe ready to start withdrawing that amount, you may be in a lower tax bracket, so you may pay less than 20%. It just kind of depends. All right, so let's get to the retirement process. The retirement process is pretty straightforward. You may initiate your logger's benefit in one of two ways. You can go to our website and complete the application for retirement, also known as the LRS 8 form. This is a paper form. You can download it, print it, fill it out, and send it in with a copy of your birth certificate. Okay, you can do that, or you can apply online through the MyLoggers portal. If you apply online through the MyLoggers portal, if you've ever used a Microsoft type product where it has a wizard, so I know for myself, occasionally I use it for like a mail merge. It's a step-by-step process, and it works very, very similar to that, where you do this step, and then you have to do the next step, and the next step, and the next step. So it's a very straightforward process. Either way is fine with us, how you apply. But we have to have that application no less than 30 days from when you want to begin receiving your monthly benefit. Your monthly benefit will begin on a first of a month. So, if you wanted to pay, if you wanted to receive your benefit, on January 1st, we would need your application by December 1st. Sorry about that. But we will accept it up to 90 days early. After we receive your application, you would receive an election for payment form. This is where you're going to elect your payment option. So as you can see on the left-hand side, there's an initial line. You will initial one of the payment options that you desire, complete the beneficiary information, and then sign it. On the bottom, there is a spousal acknowledgement of member election. We would like for you to also have your spouse acknowledge your election, because it kind of clears things up for them. If you make an election that's not going to potentially pay to them, because there are times when we get phone calls from folks that are expecting a benefit and their spouse did not elect a payment option that gives them a benefit. So we ask that your spouse does participate in this decision. Other things in that packet that you would receive with this is some additional tax information, your tax withholding forms, and a direct deposit form. Your tax withholding forms, this answers kind of a question that we just had, is the monthly benefit subject to tax? The answer is yes, it is subject to tax. And we will withhold taxes for you if you'd like. We can do several different things for you. We can apply the tax tables, kind of like maybe what your employer is doing now. We can apply a specific dollar amount per month that you want withheld, or we can apply a percentage. Finally, we don't have to apply anything as far as being withheld. However, you would still owe a monthly benefit, or not a monthly benefit, you would owe some taxation or some taxes to Uncle Sam April 15th. So it's your tax situation. You can handle it however you'd like. However, that's pretty much as far as we can go here at Loggers as far as your tax situation. If you have any more detailed questions about it, you probably should seek professional advice from a CPA. Direct deposit form, it's not required that you have direct deposit. It's just a feature that we allow you to use. So I would say that the majority of the time that we receive a lot of direct deposit forms is whenever the weather is really bad, because the folks that are currently receiving a check can't get to their mailbox or can't get from their mailbox to the bank to deposit it, and they still need to pay their electric bill. So direct deposit is really convenient. We offer that. It's not a big deal, but it's also not required. Most of you, if you're at the webinar, you have access to the internet, so you can visit our website. A lot of the information I discussed today is on our website, but a couple things I want to point out that could be really useful for you, especially those who are close to retirement, is the My Loggers portal. This portal allows you to log in and view your account information. Also allows you to generate benefit estimates and save up to 10 of them. And several other things, and like I said earlier, it allows you to apply for a retirement benefit online if you'd like. So that's where it's located. If you've already logged in, you probably know how to use it. You use user ID, click log in, and then a password. If you have never used it before, there's a button at the bottom of the login screen that says Enroll Now. You'll need to enroll, and then at that point is when we ask some information about you. And then we ask that you set up some password stuff, and then you can move into the system, and then from that point forward, you have a user ID and a password. Okay? The other things that I'd like to point out are the Facebook and Twitter links that we have. We do put out some stuff, just retirement-related information on our Facebook and Twitter. Now, that could be really useful for you. So we will. I'm not going to conclude the webinar just yet. I'm going to give you guys a chance to send some more questions to me. I'm going to look through these questions to see if I missed any, and I will answer them as I get through them. I'm also just going to go through them real fast of which ones I've already answered so that you can get the answers of them again. And then if you have any further questions, I will also answer them for the next few minutes. First question that we had is, can my son be my beneficiary since I'm single and have member contributions? The answer again to that was yes for your member contributions. But as you saw, as we went through, under option C, your son could potentially be your beneficiary as well, but not under option A or option B unless they are 40 or older and more than half supported by you. We had a question that said, what if my spouse passes first? Can I change my beneficiary? The question, you can't change your beneficiary in that case if it's under option A and option B. If it's under option C, the answer is yes. But if it's under option A and option B, you get the pop-up provision, which then pops your benefit up to the full life allowance amount. Had another question that said, wouldn't the lump sum have been the employee contribution portion, and then it would have already been taxed? The answer was sort of. It'd be a portion of that partial lump sum would not be taxable, but the rest would be. And the question was, so would the 1099 be telling us what portion of the lump sum is taxable? Yes, we do. As far as that goes, I'm pretty sure that we do. There's a box on the 1099 that says what is taxable, what is not. However, that's something, again, that you would want to check with a CPA. Good question. Someone asked, you mentioned that the portion of the benefit would be taxable. Does the retiree receive a 1099 each year? Yes. The retiree receives a 1099-R each year from LAGERS. That 1099-R will break out what's taxable, what's not. It's the document that they hand to their accountant or that they use for TurboTax, however they do their taxes. Another question, if I worked at 2 different entities, will I receive 2 checks? No. What you would receive is you'll receive 1 check. It'll be a combination of the 2 benefits that you accrued from those employers, and we'd add them together to pay 1 benefit. I'll leave it open here for a couple more minutes just in case you guys have some more questions. Oh, just missed one. Sorry. Someone asked on the LT10 plan, so a life and temporary plan, can you change your tax forms at 65? You can change your tax forms at any time. It doesn't have to just be 65. So you could change your tax, how we withhold your taxes for you at any time. So if you decide you wanted to do a percentage and then you need to up it or down or change it at any time, you can do that. It's your tax liability, so we're going to allow you a lot of flexibility with that. Do the majority that retire take the lump sum payment? I don't really know the exact answer to that. I can say that it's a popular option. And ever since it went into state law and we allowed folks to use it, it has been very popular. But I wouldn't be able to tell you if it's a majority or not. How is the monthly average salary determined? We do talk about this in our LAGERS 101 webinar, but I can go through it really quick. Depending on your employer, we take the highest consecutive 60-month average or 36-month average. This is your employer elects that out of your last 120 months of LAGERS service credit. Okay, so that is, and then we make an average out of it and we plug it into that second component of our formula. Do you withhold federal and state or just federal? We will withhold both, but only for the state of Missouri. We will not withhold for any other state other than Missouri. So if you move out of state, you have to let us know, because we will still withhold for the state of Missouri. We will still withhold for them unless you notify us that you don't live in the state of Missouri. What month should I retire? That's really just a matter of personal preference. It really doesn't matter when you retire. A lot of folks kind of time it around our post-retirement adjustments, but our post-retirement adjustments, regardless of when you actually retire, we're going to catch you up and make sure that you have the correct amount. So as far as when you retire, the best answer for that is when you're ready. Should all members of loggers have a MyLoggers account? Yes, I would say yes, but it just depends on if you feel comfortable doing things online. If you don't feel comfortable doing things online, we're more than happy to help you. You know, we can mail you stuff. We can talk to you over the phone. We're perfectly fine doing that. All right, well, I think I'm going to go ahead and close the webinar. Oh, I got a bunch of questions coming in. On the partial lump sum, do you have to take it all at once? Yes. So if you're looking at, like, say, for example, your partial lump sum is $27,000 and you're wanting to use a piece of that maybe to pay off your house, what you can do is you can still directly roll it over into an account and then withdraw what you need from that account, so then you only pay taxes on the amount that you need, not the entire amount. All right, I will go ahead and close the webinar at this point. Again, if you guys have questions or anything, feel free to give us a phone call, an email, anything along those lines. We'll be glad to help you. And if, again, we will be having this webinar, the recorded piece of it, will be on our website, and PDFs of the actual presentation, so you can print them out, will also be there. Thanks again, and have a great day.